Hello and welcome back to The Note. Now, obviously there's great excitement here in London over the Greek referendum, but arguably what's happening in China is even more important. Over the weekend, we saw what many thought was the throwing of the kitchen sink at the problem of the stock market by the People's Bank of China. Very aggressive moves to add liquidity. Since then, you've seen a further fall in the stock market. It was down well more than 20% at one point, and then a very dramatic rebound in the last few hours. What on earth is going on with the Chinese economy? With me now to discuss this is the chief economist for Lombard Street Research, Choyleva. Diana, thank you very much for joining me once more. Let's start by taking a look at your own estimates of Chinese GDP growth. Obviously, that looks quite alarming. Why is your version so different from the official version?
Well, actually, our numbers are derived entirely from the official data. Over the years, we always thought that the flatlining official year-on-year growth number was unrealistic.
Right.
So we took the nominal numbers, we seasonally adjusted them, we created a deflator out of a range of price indices they produce, and we got the numbers that we have, which immediately made more sense because they showed a lot more volatility. But actually, importantly, over the years, they have been much more in line with policymakers' response.
Okay, and plainly, if you're right and we're now showing an outright quarter-on-quarter decline, that would explain why we see such urgency by the Chinese authorities at this moment, as shown by the PBOC.
Yes, it does. We have a quarterly contraction in the first quarter of this year.
Right.
Over the course of 2014, actually, real GDP growth averaged just 4.8% in quarterly annualized terms. China's economy has lost momentum very fast.
Okay, now let's take a look at the next chart, which gives us your estimate of real domestic demand. Another obviously concerning chart. What do you think is happening to domestic demand?
This is the scary bit.
Right.
Because China, our data starts in 2004. That's the earliest we can bring it to. And this is the first time we have a contraction in real domestic demand at an annualized rate of 8% in the first quarter. During the global financial crisis, we had a technical recession in China, but real domestic demand didn't contract. Now it's a different story. This should be of even more concern for the rest of the world.
Okay, and how far does that data go back? This is in the entire Deng
Since
Xiaoping.
2004.
Okay, so this is concerning. Now let's take a look at the stock market. This is annualized data. Obviously, we've had a lot of volatility in the last 2 weeks, but the bottom line is still that the HA market is more than double where it was a year ago. How do we line that up with liquidity, with your measures of liquidity?
Well, there are two striking things. The first is, if we go back to the previous charts, that despite that very sharp weakening of growth, actually the equity market has rallied so strongly until recently. Now, I would argue that precisely because of that weakness in real GDP growth and because Beijing doesn't consider the equity market as plagued by the excesses of the past, it was in their interest to stimulate it. But the second important thing, which is visible on this chart, is this very clear break between what's happening to equity prices and what's happening to overall monetary conditions in China as measured by our measure of broad money.
So this is a deliberate attempt to pump up the stock market that we have seen over the last year, contrary to other monetary conditions.
Yes, but not by injecting a supply of money in the economy. And that normally is a more durable way of causing an asset price upswing. The whole upswing in the equity market has been driven by a change in liquidity or boosted liquidity, which means there is a decrease in the demand for holding money. And the importance of that is that this sort of upswing is very susceptible to a change in investor sentiment. And we all know that the Chinese equity market is not driven by fundamentals, it's not driven by profit, it is very much driven by liquidity.
Okay, Diana, thank you very much indeed. I couldn't have put it much better myself. There are great reasons, obviously, to worry about Greece. Perhaps there are even more reasons, given how much bigger it is, to worry about China. There was a great attempt to pump up the stock market this weekend. We need to see whether it works. It's quite alarming if it doesn't.